Jardon started in the 1960s in Wellington, a stockbroking firm named after the founder, Ron Jardon, the All Black and sailor. It got taken out in the 80s and 90s by Credit Suisse, who came to New Zealand looking to get a foothold in this part of the world. Understandably, they left 10 years later, bought out by staff and management, and became First NZ. We from there went on a bit of an acquisition and buying spree and entered a foray into Australia, which resulted in us having to get rid of the NZ name. So we had a big branding exercise, spent a lot of time coming up with ideas, and we got a branding company in, and they came up with the name Jardon, so full circle, clever people. We're the New Zealand's largest investment bank, which I've had described to me as being like the world's tallest dwarf. But we're biggest on the NZX, biggest carbon broker, biggest electricity broker, biggest dairy broker, listed derivatives, foreign exchange, financial markets, we're there. So, good touch points to our clients. In terms of my background, as Doug pointed, I'm head of derivatives at Jardon with a focus on dairy derivatives. I've been doing that now for 6 years, and prior to that I was at Fonterra, where I was the senior trader in charge of commodity risk and trading. Before that, I came probably a similar background to what Nick was describing. I'd been in banking, but I started off as a chartered accountant, sort of fell into it on my OE. So and that's enough about me and what I'm doing. And I realise that not everyone here is a dairy farmer, so I'll try and keep it a little bit vague in terms of not being too specific on the dairy futures, because I think the trade here, in terms of dairy, in terms of New Zealand, is very similar. China's emerged as a global power. They've been here for the last 10, 15 years and continuing to grow, and they want everything we can produce. So our dependence on China is key, as is the commodity boom we've seen in the last 2 or 3 years with the reflation trade, where central bank governments are trying to improve inflation. And so real assets like commodities are starting to attract a real wave of support. I put in there banking because half the conversations I have are not with dairy farmers or processors or multinationals, but are with banks and are with accounting firms, because they need to be on side because they're part of the solution. So New Zealand dairy farming went through a tremendous growth phase from 2000 to 2018, where we went from 10 billion litres of milk to 22 billion litres of milk in a relatively short period of time. From what isn't as well known is that our dairy debt went from 10 billion to 41 billion in the same time. So 2/3 of all agriculture debt was tied up in dairy. I think that gave the banks a fright, especially when we had those tough years in 14, 15, 15, 16, the 390 payout and the 440 payout. Suddenly dairy, banks are your friends, but it can be a fickle relationship. So, while things were good, they were very keen to lend out. When things weren't as good, naturally, they were very concerned about getting a return of their income. Not having a go at the banks here, I think they, as I said, play an important part, but it's understanding how to preserve that relationship with your bank. So it's all about having sustainability and resilience in your business. So to be able to go to the bank and say, I've got a plan. Recent swings in dairy commodity prices, I think I might have even been a little ahead of the GDT we had a couple of weeks ago. I mean, I've been watching these GDTs for 10, 11 years now, and the one we saw 2 weeks ago was just unbelievable. I got woken up at 3 o'clock in the morning with someone saying, are you watching this? Well, I wasn't, but soon was. And dairy farmers are seeking to get greater control, and understandably so. Even this morning I talked about to a couple of people and they said, we've seen this before. Whole milk powder's over $4,000 a tonne. What happened next? And we go back to 2013. I think there's a lot of dynamics that are quite different, but it's certainly worth keeping in the back of your mind. As humans, I think when things are good, naturally inclined to think they're always going to be. And when things are bad, we're naturally inclined to think that there's no end at the light at the end of the tunnel. And we know from experience that's not the case. So I think it's all about having a plan. Resilience comes from planning. So getting a plan in place, developing policies and strategies, finding out what's available, how can I control these risks? And there are tools, and I'm not just talking dairy, although dairy is an easy one for me, but if you're a grain farmer, obviously there's grain futures, red meat futures, there's even just currency or interest rate futures as well, to be able to help you protect whatever the big risk is in your game, because it's hard enough being a farmer, controlling the things you can control, let alone trying to worry about the things you can't. So that's what we sort of look at. You know, I have farmers ring me up all the time and say, you know, is this the top or is this the bottom? You know, should I be getting in here? I don't know, and I sit in front of the computer screen 12 hours a day and I see all the trades go through. You know, I just say to them, those who try to pick bottoms end up with smelly fingers. So, you know, we just say, look at your business. What sort of return do you need? And that's where we go. We establish levels and we establish policies and we stick to it and adhere them. You know, finance is a stressful thing for most businesses, but for farming even more so, just because of the amount of money involved. So it's important, if you can, remove as much of that risk or manage that risk, because, as I said, we've seen volatility come into dairy where it hasn't been there for 3 or 4 years. I'm sure there's enough faces around here who look like they've seen a number of cycles to know that there's something, it's unlikely to be plain sailing forever going forward. So we know that we're going to be facing, not crises necessarily, but we are going to be facing times where they're not as good as what they are today. This is just milk futures, and I'm using this as an example because it's something I know well, but it's relevant right across the gamut. So if you're looking at hedging something, that then becomes your effective price for the amount that you're hedging. So if I sell a milk future today at $7 for 50% of my production for round numbers, 50% of my milk price is going to be $7 regardless of what happens. So if the milk price goes to $6 by the end of the season, my processor still pays me $6, but I'll receive $1 from the future, the value that'll be paid throughout the season. Alternatively, if it goes to $8, my processor will still pay me $8 for the milk, but I will need to pay in $1 to the futures market. And that would be the same if you're using grain futures, if you're using interest rate products, if you were hedging currency. So all these things are very typical across financial markets. I've just got an example here because I think people like to see it played out of how farming, dairy farming especially, can use the milk futures as a part to hedge a part of their production. I spoke to Michael before and he was talking about how one of the clients that he looks at, the hedging is underwater because it's been an extraordinary season, extraordinary end to the season. You know, as I commented to Michael, I said at the start of the season, you know, Rabobank were very vocal about it being sub $5. You know, Chinese were overstocked. And, you know, I was on Jamie Mackay's show and I said, oh, that's amazing that they've got the insight because how does anyone know what's going on in China? The CEO of Glencore, who is the largest trader in the world, said he finds the demand pattern coming out of China indecipherable. So if someone like Glencore, who supplies them with the greatest amount of ore, iron ore, greatest amount of coal, greatest amount of grain, doesn't know what's going on in China, you know, how are we expected on farm or in New Zealand to know what their demand cycle looks like? So we've just got to go along. We've got to protect ourselves where we can. So much like insurance, you know, as I say to clients, we think of hedging as insurance. So at the end of the year, you know, if we use fire insurance as a good example, at the end of the year, we don't say, oh, those were premiums wasted. You know, we celebrate the fact that our house hasn't burnt down. You know, I've never heard anyone, you know, come out saying, okay, well, that was money well spent. Fantastic, I'll celebrate that. But, you know, the house is in cinders. So we're looking at here, we've got a house, a farm, 360,000 kilograms of milk solids, system 3, farm working expenses of $420, debt servicing of $1.40, and net stock revenue of 50 cents. And we're looking to hedge a third of that milk. So again, what I talked about is the hedge production at $7, and then the various different scenarios. You'll see a milk price from $4.90 through to $7.70, which is probably going to be pretty relevant because the current season looks like it's going to be around that $7.70 mark, $7.60, $7.70. I think Fonterra have a pretty good idea as to where the number sits now. And you can see that at the top end of the scale, and those prices above $7, we're giving up some of the upside because we've locked in at $7. So for our effective portion, the third that we've locked away, we receive no more than $7. But however, if you look at that, the $4.90 scenario or the $5.60 scenario, even the $6.30 scenario, we're ending up in a situation that we're better off. And so if I can sort of condense it into how things best described, you're giving up some of your upside to protect your downside. And I think that's, you know, talking about sustainability and resilience, it's the ability to be farming there and farming again next year and farming for generations. I think that's what dairy farming is in New Zealand. it's an intergenerational thing. Farming is either in your blood or not. I hear people talking about leaving Auckland for the lifestyle, go farming. They'd have rocks in their head, I think. But, it undersells what the hard work and investment that farmers make. Variation margin. So in terms of a dairy future, what you do is you place down an initial margin, which is you deposit. The NZX take that as just a means of ensuring that you're going to satisfy the contract. So it's an annual contract that settles in September of each year, but if you were doing grains, it would be a monthly contract. If you were doing red meat, it would be a quarterly contract. If you're doing interest rates, depending on the life cycle of the interest rate, FX, again OTC, but again margin involved. And so with the New Zealand dairy futures, you place down an initial margin and then each day you true up. So if you sold the future at $7 and the next day the future was to go to $6.99, you would receive 1 cent back. Each contract is 6,000 kilograms, so it'd be $60 for each contract you'd receive back into your bank account. Alternatively, if it was to go to $7.01, then you would have to put that $60 in. This is the arduous part for most people because margin is done on a daily basis, and so if you have a run that goes against you, you can be constantly topping up your margin account. Creating a strategy, I touched on this at the start. Creating a plan, I think it's all important because, as I said at the start, when things are good, you've just got this perception that things are always going to be good. And it's obviously not the case, as a number of us have seen cycles in the past. And commodities, by their very nature, are cyclical. If prices stay high, we will see supply come on board. After Debbie's presentation just then, I get phone calls all the time from offshore customers saying to us, hey, listen, when are the New Zealand dairy farmers going to ramp up production? And so I'd love them to be at a presentation like this because the answer is going to be never. But unfortunately, not everyone has the same sort of environmental constraints that we do. So the US is going to continue to produce. China produces a lot more milk than we do and will continue to do so. India, the largest producer of milk in the world, just that they only have an average herd size of 1.4 cows. So if that was to increase, it's a 2 or 3, who knows what could be possible. So we put it as a hedging strategy, and I think, we've dealt with BFA a lot in the past, and this is, I think, a cornerstone of what they speak to their clients about. And going forward, when I started off in accountancy, it was all about compliance. You got your GST returns, you got your accounting returns, but the accountants now, it's such more a dynamic industry and a better equipped to serve and provide value to business people, and that's something that we really treasure, our relationships with accountants. So it's all about coming up with a goal, identifying what your risks are, if it's the milk price, if it's interest rates, if it's FX, finding out what they are, and you're obviously best to identify those. The accounting firms can help you along and provide examples of what we've seen in the past, but as Debbie touched on as well, it's all about knowing your business, and you will obviously do. Finding out what tools are available, that's something that we can work with as well. We can tell you what products are best suited to your business and how they work and what the risks are, because it's important to know what you're up for if you get into these things. Process and strategy, how to actually use the tools. Obviously, dairy futures, it's a set and forget, basically, if that's what you're going to use it for. Grain futures are a little bit more perennial, so you have to keep on topping them up or rolling them over. And then execution, how do you go about, ideally I'd say you could ring Jardon and put the trade on, but we know you're all faced with choices, and that's fantastic. Hopefully we do a good job. And then evaluating, going back at the end of the season and saying, okay, I put on 20-30% of my production at $7, it's ended up at $7.71, I've lost out on my hedge, but it's not all about, you're not always going to win with your hedge. In fact, ideally you wouldn't, because if you are under-hedged, there's a lot of upside from the remainder part of the portfolio that isn't hedged. Target milk prices, again, and I think New Zealand dairy farmers are very good at this and have become very good at this because of the discipline that has been installed in them from accounting practices and from relationships from bank, knowing what your cost of doing business is. In the past, it was all a volume game, and that was one of the things that I think happened in 2013 that won't be repeated again. In 2013, We had a pan-New Zealand drought that rolled into 2014. There was no milk available. Suddenly China came on board. And one of those nascent economies like China were at the time in regards to dairy purchasing, they're prone to bubbles. So every man and their dog became a dairy trader over in China. Fonterra were inundated with orders at a time when they had no milk. So we were sending, I was at Fonterra at the time, we were sending milk to every Tom, Dick and Harry. The price collapsed domestically, there was no demand, it was all satisfied. Suddenly Fonterra couldn't get its money out of the people it had sold the milk to, at the same time that the New Zealand dairy farmers were ramping up production in response to the pricing signals. So I don't think any of those things are going to happen. The big GDT the other day, the 21% increase, it was the top 2 dairy companies in China that were doing all the purchasing. The other night, whole milk powder did fall 6%, but that was a massive increase in volume. And still I was saying to Michael Allen again, 77% of the product on that GDT and over 80% of the whole milk powder went to China. So there's still really good demand out of that part of the world. So long may it continue, but let's plan just in case it doesn't.